Imagine something so simple it's overlooked. It stares you in the eyes once a month, but information flows so fast that you can't keep up. You came here for the truth, so let me unveil that for you. In today's video, I'm going to explain something that's so easy to miss, and yet it's staring you right in the face. It's right under your nose. So we will look at this particular indicator and you'll understand why it's important. I'll show you the charts associated with it, and we're going to go back in history to explain why this one thing is extremely important to watch. Without further ado, let's begin. Let's look at what's happening, number one, with the US unemployment rise being on the verge of triggering a recession rule. What rule is that? Well, it's this. The rise in unemployment to 3.9% last month means joblessness is on the verge of triggering the so-called SAM rule, which is proven to be a reliable predictor of recessions in the past. So here it is. When the 3-month moving average of the unemployment rate rises by half a percentage point, so that would be 0.5% or more relative to its low during the previous 12 months. The low for joblessness so far this year was 3.4%. October's rate was the highest so far this year, following two readings at 3.8% in August and September just shy of the 3.9% level. That would trigger the SAM rule. That's right. And so where are we right now? We are at that level. It has happened. And this means that we are right there, right now. US jobless rate close to SAM rule trigger. You could see it. October's reading was 0.5% higher than this year's low. So we're basically there, right here and now. Now, it's nothing like what happened in 2020, and we're not there like 2008, and so on and so forth. This is just the beginning. But you see the trend, right? Take a look at that. I mean, it is very clear. You can see on this chart, basically zooming in, unemployment rate rises 0.5% in 6 months, triggering the SAM rule recession countdown. And that's it. That's what you need to know. I have heard others basically saying when it's below 4% and it rises above 4%, then that's another, way to look at it, a more simplified version. Either way, that's what we've seen historically. You will always see unemployment going lower and lower and lower and lower and lower. Something blows up. That just so happens to correlate with an increase in interest rates during that time. Isn't it funny? You increase the interest rates, you increase the unemployment. At some point, something breaks and unemployment will go up. Now, they can keep people employed by handing out, loans to businesses like they did back in 2020. Don't fire anybody, here's some money. The government could suddenly hire a whole bunch of people. They kind of already do that as well. There's more and more temp workers. There's more and more workers that are working for the government in one way, shape, or form. And you can do that, but can you do that for everybody? Of course not. We need small businesses to remain so that unemployment actually stays low, real unemployment. But the small business is feeling the pinch. They're feeling the squeeze. And this is the dilemma that we have at this time. Well, I don't want to talk about Lincoln Park, but I do want to talk about what happens in the end. Here we have it. Fed rate hikes, unemployment, and recessions. And time again, you see this. So that if you can look at this up close, you're going to see the shaded areas. Those are recessions. And always, leading up into that recession, we see an increase in interest rates. We see that today as well. They've been increasing quite a bit. And so, we're leading into the same pattern, right? We don't know what goes on into the future, right? We don't know. But look at what's going on in the past. One after the other, after the other, after the other. They increase interest rates. But why did they increase interest rates? Well, things were getting too hot. Things were getting crazy. And there was maybe some irrational exuberance that we've seen. Alan Greenspan, right? But it could be because of oil. It could be because of the tech industry. It could be because of, something happening in a different country. That's not the point. The point is that they increase interest rates. They tighten their policy, whether that's fiscal, coming from the government, or monetary, coming from the central bank. They tighten that policy. In doing so, something breaks. And when that breaks, companies start to lay off. Now, it might happen in one industry. It might be the tech bubble, and tech is the most affected by that. And that's what sees the probably on the biggest increase on the way up, but then it feels it on the way down the most. But it does spill over into other industries. It could be commodities. It could be anything. The point is, something breaks. Usually where that thing broke is where we feel it the most and the most immediate. And then, we have the exact opposite. They try to bring interest rates down. They try to stimulate, and they try to essentially devalue the currency. That's the whole purpose of the cycle. I don't think people put two and two together. It's almost as if these people are really incompetent. It's not incompetence that's happening here. This is all part of a cycle. And once we start to understand that cycle, some call it the business cycle or what have you, but don't get focused on terms. We need to understand that this is part of a cycle. That's all. And when I look at this, I've studied it all the way back into the past, the great inflation of Athens, the Romans, every single one. I've read as much as I possibly could about these. And I have noted the same patterns occur over and over again. And right now we are walking head first into that brick wall. So we need to realize what happens. Well, take a look. Now, this article is not new. As you'll see at the bottom, it says October 8th, 2019. What was significant about that time frame? Are you aware? Well, I was covering this one on the channel, and everybody that's been a faithful subscriber this long knows what I'm talking about. It started in September of 2019. Powell sees Fed resuming balance sheet growth, but it's not QE. Oh, that's right. Yeah, and by the way, they were cutting interest rates. So they're telling us during that period, they're saying, we are expanding the balance sheet, we are cutting interest rates, but don't go anywhere. We're still tough, we're still standing tall, and this is not quantitative easing. You can call it whatever you want. You can call it Susie if you want. But I'm telling you that this is an issue because it's devaluing your currency. You call it whatever you want. And so not QE became a term. And understand this, the balance sheet expanded during this time in which they said it's not QE, faster than QE1, faster than QE2, faster than QE3. Call it anything. You do this, you create a problem. This is what they could do yet again. It could be a backdoor. Oh no, we're going to stand tough on inflation. We want to make sure that we're listening to you. Fed listens. We want to make sure that everything is being taken care of and that inflation is in check. And yes, we are managing this appropriately. Our dual mandate of full employment, hey, unemployment's low, and price stability. We're going to take care of both of those. That's their dual mandate, as they say all the time. But there's an issue. And so we're going to go in and we're going to print a whole bunch of money. We're going to cut interest rates potentially, but it's not QE. And of course, you have to pay the price because more inflation will result, price inflation will result as an inevitable fact. Happens every single time. Now, what they do exactly, like during 2020, they were buying the corporate bonds of all the companies, including Apple. Do you remember that? Wild. They could do something else completely. They could buy ETFs of the whole stock market and lift the stock market up. They could create a subsidiary that does it because it's through the treasury, and they do it in all these funky ways to make sure that they don't have to change the law, but effectively do the exact same thing. Back in that time frame, it was weird that some people were claiming, I don't know why, I'm not sure where that came from, but they were claiming that the government, essentially the treasury, took over the Federal Reserve, and now everything was in check. the Federal Reserve would be dismantled and eliminated. In fact, we saw the exact opposite. And we have determined that the need for the Federal Reserve to be there to backstop all of this fractional reserve insanity is more necessary than ever before, because they're unwilling to admit how bad this system has been for the average person, for the middle class, for you and I. It's not built for you and I. It's built for those that sit up in their ivory towers. So that's what we've had. I think it's important to look at this, to understand it. And if you want some assistance, if you are dealing with this during this time and you need somebody, a CFP, you need a fiduciary, then check out Money Pickle. You go to the link in the description, brings you over to this page. And then once you click the link, you are brought over to the Money Pickle website directly on my page. They just changed this recently. And these are good guys. I partner with them because, they initially seemed legit. I said, okay. I talked to them. We had the call. I got feedback from others who have used it. They said they thought it was great. And guess what? It's free. You're going to get a fiduciary or CFP to look at your situation, to talk with you, and you don't have to pay a dime. So check it out. Click the link in the description and let me know your thoughts on this company. You can reach out to me directly, okay? This is the comment of the day. As always, love your comments. I would appreciate other YouTubers out there if they would care about their comments too. All you need to know is that prior to the banking crisis in 2008, credit agencies gave the banks a AAA rating right up until they collapsed. And then they turned to you to bail them out. Doesn't that seem so unusual? Because they can't be trusted. We know that. But the whole system runs on the Federal Reserve, on the fractional reserve banking, and everything else. So we've got to be mindful of that, understand that we're basically playing in their world, and so we need much more of the knowledge, of the protection, and we got to do everything that we can each and every day to stay ahead. I hope you appreciate this information. If you did, hit that thumbs up button. And of course, as always, join me tomorrow. Take care.